Welcome back, everybody, to Debits and Credits with Haas and Dawe. I'm Michael Haas, and in today's episode, we're going to be talking about outgoing changes in the escrow world. And as we've talked about before, the escrow industry, the independent escrow industry, is one we work with specifically with our audit and tax work. But we also are involved with all the escrow providers in California, whether they're with the Department of Financial Protection and Innovation, the Department of Insurance, Department of Real Estate, State Bar Association, and the banks and credit unions. And it's a very, in some ways, it's heavily regulated, but I think it's fairly regulated. And in trying to make sure that the consumers are protected and that the real estate transactions in California move forward, because no one needs a black mark against the escrow world when someone steals money or messes up a transaction. Everybody needs to be moving forward with positive energy, and that's what the regulations are trying to accomplish. Now, they're constantly changing, and there's involvement from all across the country. In California, we've talked about the various agencies under state government: the Department of Financial Protection and Innovation, the Department of Insurance, the Department of Real Estate. Nationally, there's what came out of the Obama administration was the Consumer Financial Protection Bureau, CFPB, and this is something to help protect consumers from fraudulent lending activity. But it trickled all the way down from the lenders to the title companies to the escrow world, and how escrows get done and how the consumers are notified of lending requirements and what their loan packages are going to be and what their payments are going to be and what the terms are. So no one is caught with any surprises. And this came out of what we refer to as mortgage meltdown. What was happening in the from during the Bush administration from 2000 to 2008, that there was a lot of speculative and subprime lending going on, and investors were getting involved, and the market was getting to be very, very dicey relative to how the loans were being sold and structured and how people were qualifying, and it became very difficult. And what happened was a lot of people felt there needed to be some national regulation and national oversight as what was going on in the lending community. So the Consumer Financial Protection Bureau was formed, CFPB, to oversee what was happening with the lending community. Part of what came out of CFPB was a change from the HUD-1 to a closing disclosure statement to help borrowers understand more of what was happening. The HUD-1 was from Housing and Urban Development, was a form that summarized both for the seller and the buyer a transaction. And that came out of a law called RESPA, Real Estate Settlement Protection Act, from the 70s. And what it was doing was being able to provide guidance so that people were going to know how the real estate transactions were closing and that it was going to be fair, and they could see the reporting on what went on with that. And so people felt that with what CFPB was putting together with a new type of disclosure to the borrowers, that the HUD-1 would be replaced by a new type of closing disclosure statement that the lenders would prepare, that escrow would then update relative going out to the sellers, and the buyers would see how this was all happening. This was part of something called TRID. TRID was a change that happened again in the late and mid 2000s. That TRID stands for the Truth in Lending RESPA Integrated Disclosure, where they took what was called TILA, T-I-L-A, the Truth in Lending Act, RESPA, we talked about the Real Estate Settlement Protection Act, and integrated them together into one new type of legislation to protect the consumers. And so they came up with documents, including the closing disclosure, on how buyers and sellers are going to be treated and how buyers and sellers are going to be notified of what was going on with their transaction. Now, in California, that sort of goofed up a lot of, that didn't goof up, but sort of contradicted or conflicted, or we'll say was better than what the federal government or the federal agency wanted, was that they have we call it the California closing statement. The California closing statement, again, is a summary of the buyer and the seller or the borrower on a refinance transaction of the settlement of the real estate activity. It shows the sales price, it shows the money that was put in by the buyer, it shows the new loan activity, It shows all the loan costs. It shows any payoffs of loans on the seller side. It shows the real estate commissions. It shows what the title company gets paid. It shows what the escrow company gets paid, and it shows all the other disbursements. And it's a very good summary of what goes on in an escrow transaction. And so, despite of the HUD, what had been the HUD one, it's now the closing disclosure in California. We still follow. The escrow industry still follows the California closing statement. And although it hasn't been formally admitted, it's the talk around the country that people pretty much like the California closing statement better than what the closing disclosure is. And so those are regular requirements that are helping people um, settle escrow transactions. And it is in the California regulations and the California Financial Code that the escrow companies do have to put together this closing statement, this summary of the activity, the summary of the ins and outs of the transaction that shows what the buyer bought and shows what the seller sold. And in addition, they also have other accounting rules that the escrow companies have to follow that summarize all the ins and outs. It's similar to a ledger page that'll show the money that came in, what was spent out, and being able to account for all the transactions. And these companies have to reconcile their bank account every month. Some do it on a daily basis now because of technology and because of wanting to protect people's money. Every day they make sure whatever the bank account shows is what the accounting records show, and whatever the accounting records show, the bank shows on the escrow transaction. One other thing that came out of again the mortgage meltdown period, there's these accounting audits called SOC 1, SOC, and SOC 1 and SOC 2, and the people felt that these were audits that needed to be done. And it's more of a systems oversight compliance and systems oversight check is where SOC came from. It's where a company will come in and go to the escrow company and say, we want to see how you operate. We want to see what your computer system is. We want to see how you handle transactions from depositing money to sending money out to clients or consumers on as a wire transaction. We want to see what you're doing to protect consumer information so that the non-public information, also known as NPI, is not disclosed. It's not out about it for anybody to see it. And while the SOC 1 and the SOC 2 engagements are helpful, they're not required by any industry. They're out there as something that is an internal control measure that a company can choose to do, but it's not a requirement. But it's something that is helpful. But again, it's not a requirement, as it is a costly and a time-consuming engagement to embark on. Another another element that enters the escrow company's worlds across the country and locally is when the agencies come up with new regulations or come up with changes in the law. And for example, with California, the independent escrow companies, because of budget constraints and budget issues within California, the Department of Financial Protection and Innovation, the DFPI, was given a mandate by state legislature that their budgets were always out of control, that they were always over budget. Now, the escrow industry is what comes under in California called a special budget, where the industry is assessed by the department, the DFPI, on an annual basis to cover the budget costs. And for the past 2 decades, the assessment has been $2,800 per year for every company and for every licensed location in California. And the state legislature has been putting increasing pressure on the DFPI as an agency and as a department that you're under budget. Scratch that. You're over budget year after year after year, meaning they weren't raising enough. They're coming under the needs of the department to fund what the department needed to do. And after a cost study was done by the state of California last year, they determined the fact that the budget at $2,800 of an annual assessment wasn't going to happen. And they came up with a number that is astronomical in terms of an increase of $7,215. And so effective this upcoming July 1st, for the 2026-27 budget year, all the independent escrow companies now will be paying $7,215 per licensed location as their annual assessment. It's due by June 30th of this year, but it's effective for July 1st of 2026, which is obviously a very hefty increase, and they're struggling with that on how to deal with it, but they're also structuring their own budgets on how to budget for it to be able to put it into place. And there is a provision within the law that says that there's always going to be a 2-year look back. And if there's a 2-year look back and the budget amount goes down, then the assessment can go down. But also, if the budget goes up, it also has the ability for the assessment to go up. So that's something that came after the industry fought hard against it, but the legislature still put the action through to raise the budget amount and to raise the annual assessment to $7,215. One other item that's coming up effective March 1st of 2026. So we're less than 2 months away. This is a national measure. This is affecting every escrow company and every settlement service company across the country. And it's coming out of the Department of Treasury. It's coming out of FinCEN, a Financial Consumer Crime Enforcement Network, effective March 1st, 2026. The agency is concerned about money laundering. It's concerned about money laundering. And so what is going to happen is on every real estate transaction across the country, that is where the buyer is an entity, meaning it's a corporation or it's a partnership or it's an LLC, or if it's a trust, even if it's a revocable living trust that someone has set up for their estate plan, and the transaction is all cash, the escrow company has to report to FinCEN about the transaction. They have to report the buyer's information, name, address, tax ID number, and they have to report the seller's information, same, name, address, tax identification number, and they have to report all the transactions that took place that had to do with cash coming into the escrow, all the sources of cash. So if the buyer is putting in a down payment of $10,000, they have to report that down payment, where it came from. If the buyer's coming up with a wire transfer of $1 million to close the transaction, they have to report on the source of that wire transaction, where it came from, the bank number, the bank account number, etc. And if it's a situation where the money comes from an alternate source, meaning from, let's say, from a title company, from another third party, they also have to report the source of that deposit, where it came from, the bank account information, and with the goal of trying to protect against money laundering. Now, in addition to being an all cash deal, there's a one little nuance that if the lender is not a bank, it's not conventional financing, or it's coming, let's say the seller is carrying back a note against the transaction, that's still going to be considered an all cash deal. If the lender is what we call a hard money lender, where it's coming from a mortgage banker and not from a conventional federally insured finance institution, where it's not coming under FDIC and coverage, etc., that's also considered an all cash transaction. Now, for the benefit of the escrow industry in the escrow world, across the country, there are various vendors who the escrow companies work with, or their software providers on their escrow software they use, that have upgraded their systems and are in the process of upgrading their system to provide the information relative to how to do the upload and how to gather the data and how to make it a lot easier on these escrow companies be able to send them the information to FinCEN. Because what will happen is that FinCEN is having a portal set up, and these escrow companies have time after escrow closes to upload the data, the buyer's information, the seller's information, the source of cash, into their system. It's probably going to take FinCEN a year to a year and a half to start processing all the submissions because of the volume coming in. But this is something they're going to try and do to isolate where they feel money laundering is going on and taking place. Now, our opinion, we don't think this is a big deal. It's going to cover maybe 10 to 15%, we think, of the average escrow company's transactions, because there aren't that many that are going to be, particularly in California, that are going to be all cash because of the size of the sales price and the purchase price and so on. And so it's something that we think that once the escrow companies get used to the process, it'll become something that will flow for them, because the submission doesn't have to be transmitted until the end of the month following the month of the closing. So if escrow closes, let's say on January 15th, it's not has to the submission wouldn't be due until February 28th. Now this isn't effective till March 1st of this year, so the escrow companies have 2 more months, month and a half, to get ready for it. And it'll be a struggle at first, but we think that within a month or two they'll be used to what they have to do. They'll have a process set up. Their vendors or their software providers will have the platforms available, and it'll move. So it's not going to be an overly burdensome process to be done. So that's what's coming from FinCEN. So this is just a little bit of an oversight as far as regulatory involvement or intrusion, perhaps sometimes within the escrow world. It's constantly changing, and keeping in mind that the mission statement of the regulator is consumer protection. And so you can get an idea of why they're doing what they're doing and understanding where they're coming from. And yes, they want to be supportive of the escrow entities and the escrow companies so they can do their job, but you have to make sure that consumer protection does come first. That's all for this time. We'll have more episodes coming up in the future. We'll start talking about some wire fraud issues and some specific tax issues and some other problems that have gone on. As I tell people, how to steal money? No, how to protect from money being stolen, and how you as consumers can feel comfortable that your money is safe with these escrow companies. That's all for now. Have a good day.